All right, everyone, welcome to Macro Ace with your host, Tony, going through the ECB rate decision. Of course, if you don't know me, I'm from Financial Juice, the head analyst, and we've got quite a bit to kind of cover, so let's get into it. Of course, the rate decision is happening at 8:15 a.m. Eastern Time, just if you were unaware of that. So the ECB then, we've got, so as let's start with what is the deposit rate? And what is the main refinancing rate? So the deposit rate is basically the rate that the rate that the central bank provides interest to banks that park their money at the central bank. So that's excess reserves or liquidity that a commercial bank may have. They can park it at the ECB and get a return of interest for it. So that's quite key, of course. If that starts to rise, that means that the central bank can pay more interest to those banks that are parking money at the central bank. And also with the main refinancing rate as well, we've got to understand that that's the rate that the banks are providing money to each other at a certain rate. So think of it like the overnight rate as well in Canada. That's what you've got to kind of think of it as. So again, as I said, that's the deposit rate is the first interest rate paid by the ECB to banks having deposit for the moment. Of course, now that's not negative. Now we've gone into the positive, so it used to be negative. So they wouldn't receive that much from the ECB. But now we're in the positive territory with the deposit rate. Also going to other areas too. So if we're looking at where the economy is at the moment, hey, Scotch and Stocks, good day to you too. Thank you for joining again. So other areas too. So things to be aware of is where is the economy at the moment. So inflation being at a record high at 9.1% compared to the prior of 8.9%. So this is the key thing. Inflation is still quite high, and we're as I said, record highs in the Eurozone. And there's no let up of that. And of course, that's mainly to do with the Russia-Ukraine conflict having an effect on everything from supply chains to energy and food prices as well, and agricultural goods. That's having a huge effect on the Eurozone economy. But again, inflation being at a record high, much higher than 8.9% compared to the prior. The S&P manufacturing PMI data that we had at the beginning of the month at 49.6 versus 49.7. Usually anything above 50 shows the economy is in expansionary phase. Anything below 50 shows that the economy is starting to go into a contractionary phase. Usually, some economists cite that a figure of 41, a figure of about 41.1, being specific there, shows that the economy is in a recession, or that sector is in a is in a recession and is not doing well at all. Even though anything shy of 50 or below 50 isn't good, it isn't as bad as going into the 40s or the 41 area. So that's where the S&P manufacturing PMI is, slightly worse than the prior data. The services PMI have 50.2 versus a prior of 51.2. And then if we're looking at other areas too, consumer confidence at minus 24.9 versus minus 27. So slightly better consumer confidence expectations of the economy and their own finances, but still not great compared to the prior month, compared to what we've seen historically before. Economic sentiment ticked down as well to 97.6 versus 99. German IFO business climate. So this is a survey that measures, that gauges basically the confidence and the expectations from the German businesses within, and then they kind of tell the government or tell the IFO, whether or not they feel confident in the future of the economy, where their businesses may be headed, whether they're going to be doing better or whether they've done better or done worse than expected compared to the prior month's reads. So that's quite key as well, but still at 88.5 versus 88.6. So business climate still quite positive within Germany at the moment. But of course, in other areas of the Eurozone, that's going to be a different picture altogether, where you may see those countries that don't have such strong or sound fiscal policy compared to Germany or the other advanced economies are going to have a different outlook altogether. So the German ZU economic sentiment, which is a measure of, which is a gauge of economists' views on where the economy is headed, where what it's doing at the moment now. So this was a surprising bit of data that we had back about a couple of months now, when we had seen the data hit, go into the negatives. You'd seen a negative reaction from the markets off of that data. But again, if we're looking at it, slightly better than the prior figure of 53.8 at minus 53.8, and now currently at minus 53.3. So we got that on August 25th, that data. The German inflation data, of course, it's key. That's the biggest or the strongest economy within the Eurozone area. So whatever happens in Germany will have a wider effect on other nations as well, particularly for trade and also consumer spending too. If the Germans are not spending as much, or if inflation is skyrocketing, more than likely other areas in the Eurozone economy are also going to be facing similar problems too. So CPI in Germany at 7.9% versus 7.5%, and then the harmonized CPI data, which is the gauge of what the Eurozone measures or compares the German CPI to other nations altogether, was at 8.8% versus 8.5%. So again, still quite high inflation you'd expect. So Spain, which had gone to double digits as well not too long ago. That was, of course, Spain not being as huge, as big as Germany's economy, but being one of the advanced economies in the Eurozone, which had gone into double-digit inflation. So if Germany goes into double-digit inflation, being the largest economy in the Eurozone, then there's some real concern that inflation may be sticking for longer than the ECB would hope to. So that could mean that the ECB could go for higher or bigger rate hikes in the future, if need be. And maybe they could move their neutral rates further up. Then if we're looking at the previous ECB meeting then on July 21st, so ECB, they decided to raise interest rates by 50 basis points and approve the transmission protection instrument. TPI purchases will be focused on public sector securities. So all that is TPI is that when the ECB raises the interest rates and tightens monetary policy, they basically have a mechanism, or like a fund in a way, to be able to help out those nations within the Eurozone that are struggling with higher rates of interest. So it could be buying up their bonds if debt becomes more expensive to pay off from the various governments, and there isn't much investment into those bonds, maybe from traders or investors. So that's what the TPI essentially is, dumbing it down or not insulting innocent intelligence, but keeping it simple. Basically, that's what it is. So TPI is going to be quite key to kind of see, how much they'll kind of keep buying, or what limit they'll set, if at all, or how long it will last for. In the ECB's eyes. So that's going to be something that's going to be quite key to keep an eye out for in the ECB meeting, in the ECB statement, in the rate statement that we get today in not too long. But that's just to make you aware of what had happened. Those are the key points then from the last ECB meeting. Then if we're looking at the bets and expectations, so this has more or less been clearer than it has in the past, where in the past it has been quite mixed, with traders betting whether or not the ECB will do a 25 or 50, or maybe how much they'll raise the rates by the end of the year. That's been quite mixed. But if we're looking at some of the expectations then, so JP Morgan on July 27th, they cut their ECB interest rate forecast, and they expect the ECB to deliver 50 basis point of hikes by the year end versus 75 basis points previously. So of course, in their eyes, if the ECB had gone with this big surprise 50 basis point hike, then there's less work for the ECB to do in the future. Hence, they'd gone for looking at a 50 basis point rather than 75 basis points by the end of the year. So they were expecting maybe some 25 basis point hikes before the end of the year. Then Bank of America on August 31st, they predict that 75 basis point at the ECB rate increase for today as well as for both the rates. And then Goldman Sachs also see the ECB hiking by 75 basis points on the August inflation surprise. Again, as I said, 9.1%, heading toward the double-digit zone, which when we had the last Bank of England rate decision, where they hiked interest rates, although the pound had seen some initial strengthening because of, not with the Bank of England, when we've seen the last UK CPI data, when we had seen the inflation was still ticking higher. Of course, usually that means that central banks are likely to raise interest rates to try and dampen inflationary pressures. But because we headed into double digits inflation in the UK, we did see that initial pop, and then we'd seen a move towards the downside on the pound. The reason being is because traders and investors lost a bit of confidence that the Bank of England is doing their job to curtail inflation. So key thing to take away from that is if we do go into double-digit inflation in the Eurozone, then that credibility can potentially be lost from the ECB, which is something that we wouldn't want to see. I hear a buzzing sound. Oops. Okay, hopefully that should have sorted out the sound there. Apologies, you're probably hearing that buzzing sound for quite a while. There we go. Okay, sound is all good. All right, so going back to here then. So Goldman Sachs seeing the ECB hiking by 75 basis points. As I was saying, with the Bank of England, if they kind of lose their credibility because inflation goes to double digits, the same thing could happen to the ECB, where the next inflation print that we get, if we do go into double digit growth in the ECB, we could see, in the Eurozone, we could see a movement towards a slight appreciation in the euro, but then we could see a movement towards the downside if the ECB loses, if traders think that the ECB has lost some credibility of not doing enough to curtail inflation, as we've seen with the Bank of England and the UK CPI print that we had. So that's one other thing to bear in mind. All right. So carrying on, so traders are pricing in 100 to 25 basis points of tightening by October and a better than 80% probability of a 75 basis points hike in the next month. So of course, going from August 31st, that sentiment was presented. August 30th, you had Eurozone money markets pricing in roughly 52% chance of the ECB hiking rates by 75 basis points in the September ECB watch, down from 67% chance on Monday. A lot of that is going to be, of course, the issues of Russia and how they're having an effect on the markets overall, with gas supplies, energy supplies, and how the Russia-Ukraine conflict may still be having an impact on their forecast. So ECB member views then, and other areas too, and just other views. So according to sources, because of the deterioration in inflation outlook, some ECB policymakers wanted to discuss raising interest rates by 75 basis points, of course, for this month. And then August 31st, he had ECB's Villeroy saying that he doesn't see recession in Europe this year, but nothing can be excluded for next year. August 30th, Stornoras said the neutral rate is projected to be between 0.5% and 1.5%. So, of course, we're talking about the deposit rate there for where he sees the neutral rate. But we're already at 0.5% on the neutral rate. So we've got, basically, we don't have too long. By this, when we have this rate decision, we'll basically be there. will be in that range of neutral range already. So that seems very, uh, you know, uh, it doesn't seem right for the neutral rate to be around there. I think it probably needs to be much higher, considering inflation hasn't come down one bit yet in the Eurozone. Nagel said front-loading rate hikes lessens the probability of a harsh downturn. Then Muller said that as inflation outlook has not improved, the ECB should consider raising interest rates by 75 basis points in September. So a lot of these comments, people saying that 75 basis point is probably needed within the ECB at the September meeting. ECB is not also saying that he was leaning towards 75 basis points, but he is open to discussion with it. So that's the key thing. That's why a lot of investors and investment banks, traders are looking at the ECB to do a 75 basis point rate hike at this meeting, which is, as I said in the past with other rate decisions, it's huge. It's big. It's no small feat. But if they go by 100 as a surprise because inflation is getting too out of control in their mind, in their thought process, then that's it. Then they're all right. They'll lose a little bit of credibility from the markets, expecting to do a 75, but it's probably needed in that case. But the likelihood of 75, 100 base point hasn't been presented anywhere in expectations or from ECB members at all. If we carry on this, so other views as well. So economists at Goldman Sachs and Bank of America, JP Morgan now predict a 75 base point increase, with hawkish governing council members had floated as an option in recent days. Investors are fully priced in such a move by October as well. So JP Morgan, so they said the number of policymakers at the ECB are preferring more forceful response. That was according to Fosesi, the economist at JP Morgan. Adding the Wednesday inflation data will have encouraged them further. With the relative size of different camps in governing council, it's hard to gauge after the summer break, and they now expect a 75 basis point hike. Goldman Sachs giving their thoughts as well. So Sven Jari Sten highlighted that activity data had held up somewhat better than expected, and saying that the euro area may only experience a mild downturn, seeing inflation accelerating further as temporary support measures in Germany come to an end and high energy costs continue to feed into retail prices. So that's what we have from the economist as well. Any sort of deviation from that could cause a bit of a rift or extra volatility. Key thing, when market expectations aren't met, volatility increases. Okay, you start to see bigger moves occurring. ING's Carsten saying that they still think that the paradigm shift will not last that long, and looming recessions will bring new pivots, forcing the Fed to stop hiking rates at the end of the year and eventually cutting rates again in 2023, and stopping the ECB from engaging in longer series of rate hikes. Remember, the key thing is that when the Federal Reserve takes big, massive rate hikes, that other central banks have followed suit. You've had like the likes of the SNB or the Swiss National Bank. They had taken a 50 basis point hike, still in the negative territory, but going to minus 0.25% from minus 0.75%, which they haven't done a rate hike in ages, in a very, very long time. So, or about 7 years. So that's one thing to just bear in mind, is that with the ECB, that they could follow suit with what the Federal Reserve is doing if they decide to pivot and decide to cut rates in 2023. But there has been quite a bit of a delay between the action taken by the Federal Reserve and the ECB. The ECB has taken longer to raise interest rates or tighten monetary policy. So you could see a bit of a laggard between the Federal Reserve and the ECB. So that's in response to ING's Carsten's view on the ECB. And then if we're looking at ING's crib sheet, then something that's always very useful, so particular comments then and from the ECB. So this is what their forecast is for a 50 basis point hike at the meeting. They say that, so this is the base case of what is expected. What are markets expecting the ECB to say in the statement? So the base case is that inflation is to stay high and ease ahead thanks to less supply strains and hikes. Projections show recession around the winter, a 50 basis point hike, maintaining a fully data dependent approach, and quantitative easing being unchanged in that approach as well. They also give levels on the euro dollar and also on the 10-year bond as well. But then I think the key thing is that this is what a lot of investment banks are expecting or looking at the ECB to do, is to go with a 75 basis point hike instead. And that could be that inflation could get the ECB saying that inflation is to remain elevated for longer than previously forecasted, hence the need for a bigger rate decision. Chitrabam says, at what time are they going to announce the rate? That's at 8:15 a.m. Eastern time. So we've got about 25 minutes or so before we get that. But go back to this. So quantitative easing as well. That some hints that balance sheet reduction is being discussed. That's going to be quite a big point as well to tighten monetary policy or to start doing some QT at some point down the line. And then a very hawkish would be, a 75 basis point hike signaling a 50 or 75 a move ahead, or a 100 basis point hike as seen as the very hawkish scenario presented by ING. And then also looking to start the balance sheet reduction in 2024. So there's been no discussion by the ECB of reducing their balance sheet in the past meetings that we've seen. But if they do decide to talk about, even if Lagarde says it in the ECB press conference that they'll look to start reducing their balance sheet in 2024, then that would potentially cause some appreciation for the euro and cause more volatility within the markets. And then again, inflation is seen persistently above target in the projection period. Ideally, I think personally, not as an analyst, but from my own personal point of view. So don't take it as you will. But I think they really need to start with going quite hard with these rate hikes to try and bring down inflation. They haven't seen any downward trend in inflation as of yet, and if they're going to be slow about it, like the Bank of England is, then they're going to start to lose their credibility pretty soon. If we do get into the double-digit inflation figures. But anyway, that's just a personal view. You can ignore that. But let's carry on. We've got about 20 minutes left to get the rate decision. But that's their forecast, though. So you have the very hawkish side and the dovish side here as well, looking at 25 basis point hike. Okay, I think Goldman Sachs as well, talking about energy prices for European families would rise by 2 trillion euros at their peak early next year. That was according to their utilities analyst. And of course, the reason being is because of Russia cutting off gas supply by Nord Stream 1, the major pipeline going into Europe, right? That had caused natural gas prices to fly, the euro to fall, the indices, right? All of the indices, the German or the DAX, you have the CAC 40, and all the other indices had just collapsed or seen a move towards the downside, because it's what the markets were kind of fearing, that Russia and of course Europe kind of feared that Russia cuts off supply to Europe in retaliation to potential price caps from the ECB. Excuse me, not the ECB, from the European Union, but also from the rest of the world as well, and all the other nations that kind of support the oil price cap. So that's what they feared, and that's what's come true. If we look at the market reaction, this is how the markets reacted. So the headline was Gazprom said that gas transport to Nord Stream pipeline has been halted until flaws are repaired. There was a very funny image that they put out on one of the analysts put out on Twitter of one of the pipes showing a little bit of oil on top of the pipe, or some of the pipes or some of the wires, and they said, okay, we are going to halt we're going to halt the gas flow to Europe because we need to fix this pipeline. So this is how the market reacted. So the euro collapsed. The euro moved down. Natural gas prices flew up. That's US natural gas, by the way. And the S&P 500, and as said, other indices, other indexes had declined as well, alongside with the DAX 30. Somebody said, "What are price caps? What are price caps? Ask for a friend, Archibald." Yeah, is very, very simple. The Eurozone, the ECB, excuse me, I keep saying the ECB, the EU and other nations won't pay Russia's prices. Basically, they'll say, "Hey, we want to pay this much for oil and natural gas." Well, at the moment, it's about talking about oil. So that's all they're saying. They won't pay Russia's prices. They want to pay their own prices that kind of favor them and help them. Simple. Which Russia, of course, isn't going to like, because it's like going to, I don't know, going to a retail store and saying, "Hey, you have that phone, iPhone. It's $1,000. I want it for $500 instead." That ain't going to happen. Hence, you've seen the reaction from Russia. And you had Putin recently saying that until the restrictions are kind of lifted, or the winter or the turbine needed for the Nord Stream 1 pipeline is returned, then they will basically open up the pipeline again through Nord Stream 1. But one key factor is that Europe is still getting natural gas, right? They're still getting, still getting energy from Russia, but it's just through one pipeline, through Ukraine. Of course, there is the sensitivity around whether or not that pipeline is secure or safe with the current situation between Russia and Ukraine. That's through the Sudza pipeline, whether or not that is safe or not. So that's causing nations, as well as the European Union, the bloc, to kind of consider where else they could get natural gas and other bits of it, and potentially other resources of energy from other nations or in other areas other than Russia. So that's something that's causing, that's why, you've seen in the recent days that the euro has had a bit of a tumble, or has had extra volatility creep into the markets. That's the reason why, if you were unsure of that. So this was the last rate decision then. So if I just play this here for you, if it plays. Oh. Okay, that doesn't want to play. Let me see. Why is that not working? Gosh. Hold on. Try this again. Okay. Ooh, there we go. All right. That's finally worked. Ooh, that took a very long time. There we go. It's better. Right. Let's play the video. Apologies for that. So, yes, of course. So here we are at the last rate decision that we had. And looking at we've got the euro dollar at the top there, euro JPY, the euro bond futures, and then here we have the euro GBP as well at the bottom over here. So if I play the video, it looks to be about 7 seconds before the release. I'm going to play it there. Okay. The markets are kind of waiting for the figures to come out, and then kind of see a little bit of movement going on already. And then, boom, there you go. 50 base point hike rather than 25 base point hike. And then you see that the market's going up. continuing to go up in the direction that they had, they were trading just before the figures had come out. So you can see the the euro was up, strengthening quite a bit more compared to what it had done in the past. And we'll look at the deviations pretty soon. But the key thing is that in the Eurozone, or the traders and the markets, they were expecting a 25 base point hike, not to go, to be hawkish, but not to be as hawkish as they had shown here, taking a stronger position rather than just going for what the expected was. So if we look at the deviations, then if I kind of just go, let me go through a bit more here actually, to kind of show you how the markets kind of how it played out. Okay, so there we go. So yep, the euro is still strengthening off the back of that data there, and then here we go, the Eurobond futures. Remember, if interest rates are raised, the bond yields or the bond yields go higher, and if and the bond prices go lower. So of course we're looking at the bond prices here on the feed. Okay, so that was the reaction from the euro, and there we go. So if we kind of let's keep going ahead. What else we got? Okay, so let's show you the let me show you the deviations then with the economic release. I'll bring that up here for you. Now, the deviations is something that or anyone who subscribes to the mailing list has access to. So what it shows you is the releases that we are doing on the financial news site, and going through Macro Ace. What it shows you is, it shows you the deviations basically between the forecast figure and the actual figure, and how much that moved the market by, right? And in different circumstances, so for instance, if we're looking at the ECB back on July 21st, we've seen that with that surprise rate hike of a 50 base point hike rather than a 25 base point hike. Of course, that's a deviation of 0.25%. Okay, and this is how the markets reacted. So the FDAX, or the DAX, or the German DAX, went down by 102 ticks, and then after about 10 minutes of trading, it was up by 29. The Stocks 50 was down 26 ticks and then up by 5. After about 10 minutes of trading, that's what the figure in the brackets represents. The euro dollar had seen 50.9 pips up, and after about 10 minutes of trading, it was still up by about 46.6, 46.5 pips. Biggest reaction that we had seen was from the more exotic, or from the commodity-based currencies. So the Aussie dollar, the New Zealand dollar. So we had seen about 65 pips towards the upside of the euro dollar. Oh, excuse me, on the euro Aussie dollar, and the euro New Zealand dollar, we'd seen about 69 pips towards the upside there. The euro Japanese yen had the biggest reaction out of everyone. Of course, they're sticking with their monetary easing, and hence we'd seen 71.6 pips towards the upside there back July 21st. So if we're looking at the past reactions and what's been the biggest mover, overall, you can kind of say has been, has been the Japanese yen, or the Euro JPY, Euro New Zealand dollar, Euro Aussie dollar, and then of course, if you're looking at what's had the biggest movement in the stock in the indexes, then you'd see like the FDAX had the biggest reaction last time around from what we had seen. So that's the deviations then, and of course the Eurobond futures, which we're looking at here, which we're looking at there, had seen a 102 ticks towards the downside, and had then, after about 10 minutes of trading, was still down by 104 ticks. So that is the deviations then for the economic release. So this is what to expect then. Now, if the rate decision comes in line as expected, then you're not really expecting too much of a reaction to happen from the euro itself. Okay, you might see a bit of a pop towards the upside or a bit of downside movement initially, or also whipsawing. Let me put it that way. On the first candle, and then for the market to kind of just carry on in its in this direction it was heading in for the day. Or, so that's one scenario. If both the figures come in line with expectation, you're not expecting too much volatility. However, like I said earlier in the video, if we do see a deviation from a 75 basis point hike to an actual, let's say, 100 basis point hike, then you'd expect more volatility from the euro, and you'd expect some more appreciation from the euro if they go with a 100 basis point hike. So that's one thing to bear in mind. Now, of course, on the flip side, if they go lower than expected and they go with a 50 basis point rate hike, then you could see, again, as I said, more volatility, but you could see some weakening from the euro instead, if traders and economists were expecting or trying to price in a 75 basis point rate hike. Obviously, there's something wrong if a lot of the ECB officials are saying that they're open to a 75, or there needs to be a 75 basis point rate hike at the September meeting, but they decide to go for a 50. Something's going on in the Eurozone that's wrong. Maybe the outlook isn't as strong enough as it was last time around for the ECB to go for a 75 instead. So that's one thing to consider, that you could see a strong amount of selling as a potential scenario for the euro if we do get a 50 basis point hike rather than a 75 basis point hike from the ECB. And then finally, the final scenario, if we get one hike of 75 basis points and then one hike by 50 basis points, that is going to cause pandemonium, where you're going to see probably a lot of whipsawing going on from the markets, from the euro. And traders will be trying to think, well, yes, they've raised rates, but they've done one in line with their expectations and the other not in line with their expectations. You could see, you could either see a strong amount of selling that's going on that could happen for the euro, or you could see a mixed reaction from the euro instead. But there would definitely be a lot of volatility that would be there within the market, if market expectations aren't met. And we've seen in the past when market expectations are not met, or lower than expected, or much higher than expected, then you see more volatility that occurs. So yes, somebody did rightly say we had 10 minutes to go. Now we've got about 7 minutes left to the rate decision. But yes, so hopefully that should kind of explain the scenario to you. Of course, for Eurobond futures, if we do get an expected data, then you wouldn't expect too much of a reaction from the Eurobond futures. But if we do get anything higher than expected, you'd expect bond prices to head further down. We'll see a big, strong reaction towards the downside. And then on the flip side, if we go for a 50 basis point rate hike rather than a 75, you could see bond prices heading higher rather than lower, and the bond yields would head lower instead. So those are the scenarios there. I hope that is clear for everyone. Let me get my tick strike open and ready. Alrighty. Okay, so we've got I've got my tick strike open here, as said. One thing I've done is what I've got here is, now if you're looking at trading different releases, like what I've done here is I've set my if you're familiar with tick strike already, then you'll kind of know this already, or you might not know this, or you know this already. But I've saved my workspace, so when I'm looking at the ECB rate decision, I already have my filters set, or the tickers that I want to look at for the ECB rate decision, and you can do that for as many as you want for different economic releases, maybe speeches that are going to be coming out from the ECB or the FOMC or the Bank of England or the Bank of Canada, and so on and so on. So you can do a lot with tick strike there. as well. So we got to have set for 5 minutes now till the rate decision, and let's see what we get. All right. So of course, so now we're looking at Financial Juice. Okay, Financial Juice Pro, where you get live voice and text headlines appearing to you in real time, right? The reason why having a live voice and text service is key and important and advantageous is because, one, investment banks use it themselves, right? They use the live voice and text feed service to manage their trades, capitalize on potential trades as well, and then also, to be aware of what's going on, right? There will be a lot of news that occurs, and fundamental news, more or less all the time, most of the time moves the markets, and then it's left down to technical trading and how the markets react to it and what they do. But it's a very, very key thing that you can't really keep your eye off. You should have access to something like that. So what we want to do is for you guys is provide you with a 7-day free trial of Financial Juice Pro. Which is there. Now, with Financial Juice Pro, if you're using the light version of Financial Juice Pro, that's fine. But the key thing is that with the light version, with the Pro version, you don't get any adverts playing. You get live data, so there's no delay to the site at all. And you also get your economic triggers too. If we're looking at economic triggers, if you put an economic trigger here, let's say for the ECB to do, let's say 100 basis point hike, right? Instead of a 75 basis point hike. You can put, depending on what you're buying or what you're looking to trade, you can kind of set it to whatever you want to do. Ignore the number there. That's just the forecast. So you can we're not telling you what to do. Just whatever, you can put whatever number you want in there. So you can set your economic triggers for your economic release here that you set up manually yourself. And when the release comes out, and then instantly, once a figure comes out on the site, along with it, you'll get the buy or sell a little notification there, or alert there, if it matches the trigger that you've set for the economic release. So that there is a 7-day free trial for you for Financial Juice Pro. Have a look, play with it. We've got about 3 minutes left to the release. I'm going to shush my mush in a little bit. And what do we do here? Galaxy One says, so you expect the D to rise 50 basis points instead of 75 basis points to get this right. That's one potential scenario. So if the market expectation isn't met, Bund futures, the prices of it, that you could see a movement towards the upside instead, if the markets were expecting a bigger rate hike, right? It's all about market expectations. That's one scenario. Or you could see a little bit of strengthening from the Eurobond futures. But again, in the past, when we've seen the market expectations haven't been met, the bond prices usually see a bigger amount of volatility, and they could, that's what you should expect from it. But that's hopefully that kind of makes sense for you there. Okay. So we got 1 minute remaining now till the rate decision. Okay, let's see what happens. Also, keeping an eye on the comments too. That's going to be quite key to see how the markets react. Ready? Are we ready? Is everyone ready? Okay, so remember, it's looking for 75. Markets are trying to move already. Oh, looks like the Eurobond futures is moving. FDAX kind of. Okay, 10 seconds. Still waiting. hike, 75 basis point hike, 75 basis point hike as expected, and the deposit rate 75 basis point hike, 75 basis point hike as expected. So a little bit of strengthening from the euro there, just a little, not too much of a great amount there. Kind of as expected, you might get a little pop, and then we'll see if we get any movement towards the downside. But then there we go, as expected. No big surprises from the ECB. Let me check. Okay. Right, let's have a look at the comments then as well. Let's see. What? Hold on. Let me get rid of this. Hold on. Okay, there we go. So bond prices are going higher. So they'd seen a bit of whipsawing there before the markets had reacted. So did see some movement towards the upside of bond prices for Eurobonds, FDAX, so the DAX, movement towards the upside there. There we go. As expected, didn't see huge reaction from the euro. Didn't really see any weakening from. We did see a little bit of a weak there towards the downside. Let's have a look at the comments then. The key thing that's going to be quite key, as I said. Let's take a little look. So, okay. There are a lot of comments to go through. So they decided to raise three interest rates by 75 basis points. Let's see. So they will regularly reevaluate policy path in light of incoming data. Eurostat's flash estimate that inflation reached 9.1% in August. Soaring energy and food prices, demand pressures in some sectors owing to reopening of economy and supply bottlenecks are still driving up inflation. They expect the economy to grow by 3.1% this year, 0.9% in 2023, and 1.9% in 2024. And in case future roll-off of PEP portfolio will be managed to avoid interference with appropriate monetary policy stance. What else they got? There is... Okay, as concerns PEP, ECB intends to reinvest principal payments from maturing securities purchased under the program until at least the end of 2024. It's more or less the same. There's nothing really interesting out of here. Hence, I think why we're seeing this. Hence we're seeing this sort of market reaction. Just saying that they must guard against risk of persistent upward shift in inflation expectations. Okay, yeah, that's basically it. There isn't anything else. There wouldn't be anything else. There isn't anything else to that. All right. So the rate hike was as expected. So you didn't see too much of a market reaction from the markets overall. Just as I said, as I was kind of expecting a bit of a whipsawing to happen on the euro. FX Expert says, wouldn't this rate hike be very bullish for the euro? Now, if the rate hike was higher than expected, right, then you would say it would be, then there is the scenario for it to be very bullish for the euro. But traders had been pricing this since the last, just after the last ECB meeting that we had. So if they've been pricing it in, you're not really going to see too much reaction from the markets. There's no surprise. Okay, so if there is a surprise, you'd expect more volatility. if it doesn't meet expectations. We didn't get that today. It was as expected. The minutes seem quite boring too. Excuse me, the statement seems quite boring too. You don't really see anything surprising in there either. So, okay, now we're seeing the euro heading down. But yeah, as I said, it's as expected. So you're seeing the reverse happen. So it's more like buy the rumor, sell the news in that way. Yeah, that's how you got to kind of treat it. We'll keep an eye on what markets are looking to do. But I don't think markets have given their expectations yet. All right, let's have a look at some of the comments as well. So also just finally then, I'd seen some comments of asking, whether the deviation sheet is free. Can we provide it in the macro ace mailing list? Yes, it is. So if you want to have access to that, to the deviation, not only just the deviations for the upcoming economic releases for the week, but also the expectations of what to look out for in the Asia session, the European session, and the US session, and the summary of weekend news. There you go. You can subscribe to the mailing list that I've just put in there in the chat. So if I just bring up the what the week ahead prep looks like for you, so you've got a bit of an expectation. Let me bring it here. Here we go. So this is the week ahead prep. So you have, not only do you have the upcoming economic releases and the times that I'll be doing them, but also, as I said, the week ahead, what to expect in the Asia session, Europe session, US session as well, and the summary of the weekend news to kind of prepare yourself for the Monday to kind of keep an eye on for. And then also, as said, we'll also show you the deviations for the upcoming economic releases. So on Sunday, once a week, I send out the report or the email to our peeps or to the macro races, to the macro race heads or the macro races, and for the upcoming economic releases, and you can see how the data or how the markets have reacted to the data. So that there, is, I'm hoping, kind of seeing from what the comments section I've seen here in the chat, that it is a useful thing for you guys to have. So that again is free. All of this is for free. That's the beauty of it, right? This is information that traders need to know and need to understand, right? If you don't understand the economic release, or if you don't understand how the markets have reacted in the past, right, and you don't kind of prepare yourself for it, then you're not really putting yourself in the best position. So that's what we try and aim to do, is to try and prepare you for the release as best as we can with the past information and historically how the markets have reacted in the past and what that could mean for the future as potential scenarios. So that, again, not only do you get the deviation and the week ahead, but you also get the links to the videos as well in the mailing list too. So that's macro ace. Of course, if you like the video and it helps you with your trade today, then don't forget to like and share the video, subscribe to the channel, and don't forget to give us a follow on Twitter as well. Show us some love. Show us some extra love here. There you go. That's the Twitter page. You can follow us on there. Also with Tick Strike. So Tick Strike, which you saw there. Let me just bring it back up. Let's bring it back up here. Okay, so Tick Strike here. So if you're unfamiliar with Tick Strike, all it does is it measures the order flow, the strength of the order flow, right? It measures the momentum of order flow, whether there's a lot of buying or selling a momentum that's going on, and I'll show you visually and audibly as well. So if we're looking here on the euro dollar, we can see a lot of buying momentum creeping in to the euro dollar. Now, level 1, what does this number mean, right? So level 1 is when that ticker is the most sensitive to the market reaction. So if you do see a little bit of movement towards the upside or downside, then Tick Strike, as it's kind of doing now, it will kind of go up, right? And it will appear here. But what you can do only if you want to see a big amount of momentum of buying or selling that's going on within the markets, then what you can do is you can increase that level all the way to level 15. Don't forget, you can kind of chop and change. But level 15 is the least sensitive to market reactions. Okay. Only then, if there's a big amount of buying or selling momentum that's going on in the markets, only then would tick strike go off, or that little ticker go off for you. There is an audible sound that you can have with it, but I've kind of turned it off because otherwise you'll constantly hear it going off. But that's tick strike there for you. So again, we've had people in the past that say they use it to, if you're a scalper or you're day trading, then you can, some people use it to manage their trades, to capitalize on potential trades or the volatility or momentum that, is presented in the markets. But it doesn't mean you can, you have to use it that way. You can use it however you want to use it, right? There's no, find a way that kind of works for you to work with tick strike. So we've provided the link for the 7-day free trial there for you to have a look at, have a little play with, see what kind of suits your style. But the key thing is we have a load, not only just Forex and so the futures, but we've expanded that. So we've gone into crypto. We've gone into the stock area as well. More stocks are being added as well. ETFs and ETNs, and also internals, right? So your VIX too. Actually, let me open it up. Let's see what we're like. Let's see how the VIX is. I'll just keep that there. But yeah, so that's tick strike there for you. So you get a 7-day free trial, and then finally, we also launched a new service of unusual activity. Okay, so unusual activity. So if you like to trade unusual volume activity in stocks, then you can join the free beta test group of our new service. Not only is there just stocks, but there's also crypto now. There's currencies as well and futures as well with unusual activity. So you can join that free beta test group. Okay, have a little play with it. Have a little look at it. See what you think of it. But the link is there as well in the chat for you. As well for you to have a look at. So that basically concludes the release for you. Not really a surprise, no surprise from the ECB. Hence, you're seeing not much of a volatility in from the euro, from the markets, or you're not seeing one clear direction for the euro. You're like shooting up or shooting down. There wasn't anything surprising about it, so hopefully that kind of made it clear. There's a lot. The thing is, I turned to my middle screen, and then I turn to my right, and I see all these comments kind of like flood through. It kind of goes a bit crazy. We got some questions here. Archibald, so let's kind of go from the top. Master Roy says hello from the USA. This is before the release. Tawanda Chimwara said hi. Hey Tony, is this spreadsheet for free? Because I want it. Hopefully I answered your question there earlier on. Paulo Santos. Hopefully I said your name right. Paulo Santos. Due to the shutdown on Nord Stream 1, unexpected data could realize. Malik Shah Shemshek said, Tony, can you share spreadsheets? Well, everyone wants a spreadsheet. Great. Good. FX Buzz. Nain says, what would be the consequences for the Nasdaq 100? Well, let's have a look. I don't think anything really, to be honest, unless they went with a surprise 100 base point rate hike. Let's have a look at the NQ anyway. Yeah, there we go. Say 15. There we go. So yeah, not much of a reaction there from the NQ for you. Similar to the FDAX or to the DAX German index. But as said, if the ECB decided to go for 100 base point hike, then you could have seen some movement towards the downside on the NQ. Although there isn't a lot of There wasn't a lot of volatility before the rate decision, compared to the DAX, of course, being in the European session, the European time. But that could have been the reaction. You could have seen some downside movement if the ECB went with a higher than expected rate hike. Archibald, I'm getting to your question. Do not worry. Tony, your question was, Tony, what are the major top correlations to global financial markets? Obvious ones are gold and the dollar. If the gold goes up, if gold goes up, the dollar goes down, right? It costs more to buy gold. And then you have your bond yields and your stock indexes, right? So when in this current scenario, and I've talked about I've talked about it in one of the webinars that I've done in the past. But if you see in this current rate hiking environment, when rates are being increased, the bond yields rise further, okay? And of course you have traders pricing that in, and stocks, start to head lower. So in this current scenario, bond yields have an inverse relationship to the stock market. So if you do see higher bond yields, you usually see lower stock prices and stock indexes. But again, we're in a rate hiking scenario at the moment that doesn't always hold up, but that's what we've seen historically in the past with previous releases too. I guess once we kind of pause with once we kind of hit the pause button on the rate hiking path, and the ECB or the Federal Reserve says they've kind of done enough, then if they do decide to kind of if they do kind of pause, then you could see that relationship unfold. We could see them moving in tandem instead, which is what they used to do in the past. But we've got to kind of wait and see how the markets react. Sentiment, we've got to kind of be aware that sentiment can change. The market reactions are not always going to be the same. So you're relying on historical data and what charts have done recently in the past as well to kind of say, yeah, okay, this is a relationship that I currently see at the moment. Of course, the big old key thing is that dollar and gold have always had the same relationship. So that's never going to change, really, unless you have a new war where everyone goes into safe haven assets and they get scared, and then you see the gold and the dollar go up in tandem together. Archibald says, do you think there's any chance of trading the US jobless claim coming now? And also, what are the major top correlations? I think I've answered the first half of that. Chango Shin says, you can't really trade the US jobless. Instead, you may bet bond yield direction with your bet. Okay, that's what you say. Initial jobless claims hasn't seen much of a reaction. And if I bring up, I mean, like here, the data's already come out. So if we're in a situation, the only time the initial jobless claims could be tradable, what we've seen during the pandemic, is if the initial jobless claim, if jobs is a very, very key sticking point that the Federal Reserve or central banks are focusing on, or if that becomes the sentiment, right? And I'll repeat it again like a broken record. Sentiment is very key as to what the markets focus on, what releases markets focus on. So the moment inflation is a very big thing in the economy, in the global economy. In the past, when inflation was kind of dawdling around and not doing too much, or overinflated, or heating up too much, it's still quite important release, but it wasn't going to have such a big reaction compared to as it does now. So sentiment can change. Jobless claims, when you see job losses happening within the, within an economy, and the central bank say, hey, jobs are not holding up, the economy is starting to falter, where people are actually being looking to file for jobless claims, then it could become more important. Just like we've seen in the COVID pandemic, when you'd seen the huge amount of job losses that had occurred, you'd seen a negative reaction from the dollar, and when there's a positive figure from jobless claims, then you'd seen a positive reaction from the dollar instead. So that's what we've got to kind of be aware of. Sentiment is going to kind of tell you what to look at, which releases to focus on. That's what we try to do here at Macro Race. That's my job. That's our job here. All right. So, ladies and gents, I have spoken for a lot, and that concludes the rate decision then from the ECB. There's about 10 minutes left till the till we get the press conference from Lagarde. But what I want to do for you guys is I want to share the video for tomorrow that we'll have. Of course, the Canadian employment change data. Of course, it's not a huge release compared to non-farm payrolls, but still quite still quite an important release to look out for. So let me share the link for you here in the chat, which is there for you for tomorrow. Again, that will be as I said. So that release we'll be doing it at 8 a.m. Eastern time, going through the prep there. Of course, the release is happening at 8:30. All right, ladies and gents, thank you very much. Enjoy the rest of your day. FX Bears, did you see my email about Japanese yen and the potential, for intervention, or if there is an intervention from the Bank of Japan or the Japanese government? Hopefully, you got my email. If you have any other questions, then don't forget to email me at tony@financialjuice.com for any sort of if there's any issues with your subscription to the mailing list, or maybe you have any other questions, then don't forget to email me there as well. Also provide your feedback too, whether you liked the content or not. That'd be great to kind of share with peeps too. Alrighty, thank you very much, and I will see you tomorrow in the morning. Archibald said, "Thanks a lot, Tony. This is the best job you're providing." Thank you very much. And Chango Shin says, "Thank you for your broadcast." Thank you very much, guys. Bye.